Is the Florida real estate market finally going to crash here in 2023? With prices approaching an all-time high again here in 2023 and interest rates creeping up to 7%, it appears the Florida real estate market is poised for a market correction or a crash. So many YouTubers have been predicting a real estate crash here in Florida for the past year, 2, and 3 years and more. But why hasn't it happened yet? In this video, I'm going to share with you my 36 years of actively selling real estate here in the Melbourne, Florida area. I've been through good markets and bad markets. I'm going to share with you my thoughts on the Florida real estate crash, when it's going to happen, and how you can prepare for it. And we're going to do it right now. So when considering a market crash, we first have to decide what is a real estate market crash. So a real estate market crash could be a different combination of different things, and it can mean different things to different people. So anytime the market price and the valuations go down, that's not a good thing for us homeowners. We don't like to see our assets go down in value. But what actually is a market crash? Is a market crash a 5% reduction, 10% reduction, 20% reduction? So in my opinion, a real estate crash is more of a severe disruption to the market. And for me, a 5 or 10% reduction isn't necessarily a market crash unless that happened overnight. And most times crashes or reduction in value doesn't happen overnight. So to me, a market crash is more in the line of 20% or greater in reduction in value. And we've only seen one time in history of real estate, and that was back in the crash of 2008, where this actually happened. And again, the real estate values in Florida reduced by 40 to 50%, and the average across the United States in the crash of 2008 was about 30%. Okay, if I'm establishing now that a real estate market crash is 20% or greater, again, that's just my opinion, what actually will cause a real estate crash? There are several factors that could cause a real estate crash. And the first of all is an economic downturn or a recession. So when there's an economic downturn or recession, people are just not able to buy products and services like they normally would. There's usually a little less money in the system, and or prices could be quite a bit higher. So there is a great risk today in our market today that we could be entering into recession. And that is something that has been on the minds of people now for several years. In fact, the economists in the U.S. will say that the economy actually went into a recession for a brief period of time in 2020. Now, many of us, including myself, believe that we've been kind of hovering around a recession for the past 2 or 3 years, but other factors have been positive, which is why I believe the government actually hasn't said we're in a recession. But still, through this period of time of so-called possible recession, real estate values have gone up. So that's just one factor why things could turn the real estate market into a crash. Now, another cause for real estate crashes are speculative bubbles, when investors drive up the prices of real estate. And actually, this is what actually happened in the crash of 2008. So if you remember back in the early 2000s, we had a stock market crash, and a lot of people took that money out of the stock market and they wanted another vehicle to invest their money in. They put their money into real estate. So in the early 2000s, investors were putting money into real estate. They were flipping homes. They were buying new homes. By the time they'd be constructed, they were selling them at a profit for 20, 50, even 100,000 over what they bought it for. And this was driving prices perpetually in the 04, 05, and 06 timeframe until the end users could no longer afford those homes. So a speculative bubble when it comes to investing is definitely one way that a real estate market can crash. And that was one of the main reasons why it did crash in the crash of 2008. Okay, another reason why the market could crash is just an oversupply of properties. So when there's an oversupply of properties and people aren't buying them, that's what will cause the real estate values to come down. So there's been a period of time where there's been a large supply of homes, but people are buying them. So if they're buying them, then that's not going to cause a crash. But an oversupply will eventually drive those prices down, especially when people are not buying them, or actually only when people are not buying them is when an oversupply will affect the market drastically. So another reason for the cause of the crash of 2008 was the fact that lending practices were much different back then. There was a lot of shady lending practices, subprime loans. People were given loans that really didn't deserve to get them. They weren't financially stable. And a lot of times these people put little to no money down, and in the fact that hopeful that the prices would still continue to go up and that they would have equity. Well, by the time the market started crashing in late 2006, 2007, these people had very little equity in their homes. They really couldn't afford it. They were financially very unstable. And that caused a lot of people to put their homes on the market when they couldn't sell. People got worried, and then more homes came on the market for sale. And then the market was not able to accommodate that supply. So the demand became less, the supply was greater, and thus the perpetual movement of the market crash because of the high supply, low demand. My name is David Jelinek. I'm a local real estate agent here in the Melbourne, Florida area, which is also known as the Space Coast. Please know that I make videos that are all about the Melbourne, Florida area, what it's like to live here, what it's like to work here, what it's like to play here, the food, the beaches, the entertainment, the real estate, and much, much more. I've lived in this area for 40 years. I've been a realtor for 36 years, and I sold hundreds and hundreds and hundreds of homes in this area. And I want to tell you the story about Melbourne, Florida. If you're considering a move to the Melbourne, Florida area, please consider hitting that like button, hit that subscribe button, click that little bell. That way you'll be notified every time I drop a new video just like this about Melbourne, Florida. And hey, I'm getting calls almost every day from people all across the country. People are considering a move to the Melbourne, Florida area, and I absolutely love it. However you decide to contact me, please know that I've got your experience and I've got your back when it comes to making a move to the Melbourne, Florida area. So is the real estate crash of 2008, well, is that similar to where we're at right now? Well, again, in 2008, the crash of 2008, a lot of investors had a lot of money into real estate, just trying to make money, and flip properties to make money. In this market today, we don't have as many investors that are out there flipping properties. Yes, there are some, there always will be. We have the Airbnb phenomenon, which we'll discuss later. But a lot of homeowners that are in their homes now have a very good equity position. In fact, on average, it's stated that the average homeowner that has a mortgage has an average equity of about $275,000 as of the first quarter of 2023. So this is much different than it was back in the 2006, 2007, where a lot of investors had money into it. They actually had financed them completely. They were trying to flip them. And once they couldn't flip them, prices came down and everybody else's price came down on their homes there. So it's a little bit different today's market. It's not investor driven. People are more to their homes, have equity positions. It's not as unstable in an equity position as it was back then. So that's a big difference in today's market. Well, another thing is when people bought these homes, the lending standards are much different today than they were back in the early 2000s. So again, I mentioned that a lot of subprime loans were done. There were a lot of shady practices. People were just given money, buying homes, and everybody was happy for a long time until the market hit the wall there. Well, that's not the case anymore. You cannot just easily get a loan today. You have to have a very substantial financial backing to get the loan. I mean, they scrutinize everything when you're getting your loan today. So there's not a lot of unqualified people actually own homes today. And the fact that the values have gone up here in the last 50% in the last 2 or 3 years, in many cases, people have an equity position. So if they're losing their job or having a problem, they can actually sell their home and make a profit on it versus just letting it go to foreclosure. Okay, so what could cause the Florida real estate crash of 2023? So let's make it clear. There will be no crash unless there is an oversupply of inventory and the undersupply of demand. And right now, we're still sitting on the opposite. We're still sitting where inventory is low and buyer demand is actually still pretty high. Now, it's true that in the first half here of 2023, that inventory and the absorption rate is actually going up about double. In the beginning of the year, we had about a 1 month supply of inventory, and now that's actually up to about 2 months supply of inventory. So the inventory is up there. It's gaining a little bit of steam there, but we're nowhere near the inventory and the absorption rate where we were back in the crash of 2008. And for those who don't know, the absorption rate is basically the amount of homes on the market versus the amount of homes that are being sold each month. So if we have 100 homes that are on the market and only 10 are being sold per month, then your absorption rate is 10 months, meaning it will take 10 months to absorb or sell all of those homes. So in a buyer's market, there's 6 months or greater of inventory. In a stable market, it's more in the 4 to 6 months time of absorption rate of homes that are on the market. And then below 4 months inventory is where we see a seller's market. And right now we're at about 2 months inventory here in the Brevard County area. So again, back in the crash of 2008, when market values started to soften up in 2006, the mid 2006 timeframe, here in the Melbourne area, we had inventories of active properties, which included those under contract, of about 4,000 when it came to single family residences. We had about 4,000 properties that were active. Now, as the market got worse and the crash started happening and demand got less and the supply got more, there was a point in 2010 where there were 10,000 single family residential properties on the market. And that grew, of course, from about 4,000 to about 10,000. So it was about a 250% increase. You can see where the supply was drastically increased. A lot of those were foreclosures. A lot of those were short sales, which take time to develop and take time to sell because they have to go through the process. But that is one reason, and you can see that you will not have a market crash, a significant market crash, unless supply is significantly increased and demand is significantly lessened. Now, how is that formula going to happen today? And can it happen today in the US? And can it happen in Florida? So I'm going to speak more to the Florida market. The Florida market, I believe, is going to be a little bit better when it comes to on average than the average US market, only because there's an influx of people every day coming into Florida. Florida has a high demand for real estate, and it will continue to be a high demand, even though the prices are going up. Insurance is high, there's a lot of things high, but there's still an influx of people that are coming here to Florida to buy. So if we're going to see a Florida real estate market crash, again, we've got to see inventory go drastically up and demand go drastically down. So how is the inventory going to go drastically up? Well, there's a lot of people sitting on the sidelines that want to sell, want to buy, but they're not because they have a low interest rate loan. They have a 2, 3, 4% interest rate loan. They don't want to sell their home and then go out and buy another home and have a 7, 8, or 9% loan. So there's a lot of people across the country that are sitting on the sidelines because of this and this reason alone. So there's not a danger of these people dumping their homes because they have a high equity position, they have a low interest rate. They're just not going to sell. So where else in the market is the capability for inventory to be greatly increased? And to me, the most significant number that is hanging over our heads is the amount of corporate-owned homes in the United States. So the corporate-owned home became a phenomenon back in the crash of 2008. Back then, a lot of corporate entities for their investment portfolios, they would buy more small unit apartment complexes or a combination of different things, but they're basically more multi-unit complexes. But when the real estate market crashed in 2008 and subsequently got down to its lowest in 2011, 2012, a lot of corporate entities started buying single family homes because they felt that they were very undervalued, and they were. And they started buying them, and they've been buying them in record numbers since. And they've done so. They've gone out there, they put them into their rental program. And as of today, almost a quarter of the homes in the United States are owned by U.S. corporations or corporate entities. Now, for me, that's a shocking number. And that's a big slice of the market where these people are owning these homes for investment purposes. Now, over the last 10 years, they were able to buy these homes at record interest rates. In fact, they have access to loan portfolios and investment rate portfolios and mortgage programs much better than the average individual like you and me. They're able to buy these homes for virtually no interest rate, almost given the money to buy these homes. That's why they did. They don't necessarily need a high ROI return on their investment, but they're using them in their portfolios for different retirement programs and things like that. So in my opinion, that is could be the potential game breaker is the corporate owned properties. If they start dumping these properties on the market, which would not be to their benefit because then their value of their portfolio would go down. But if they do, that is where the shadow inventory really exists that could change the market overnight. Now, is that going to happen? Again, I don't think that's going to happen, but to me, that's where it could happen, where we could see an increased supply of inventory because of this. I don't see foreclosures becoming a significant factor because overall there are high equity positions in a majority of the positions of people that have loans in their property. And it's stated that about 65% of home ownership have loans on their property. And again, 90% of those have rates under 6%. Then it also has to have the other side of the coin where you have to have low demand. And right now, there still is a very high demand on values and high demand on purchasing. And right now, I've got a lot of people, as do other agents across the country, have people that are waiting for the market to go down. So there's a lot of cash on the sidelines, or there's a lot of purchasers that are on the sidelines, there's a lot of cash buyers. So if values start to come down, I believe that we will still see an unleashment of a lot of people coming and buying bargains, especially in the Florida area, where Florida, again, is still a very high demand location. So in my opinion, there is definitely room for prices to adjust in the Florida market and in the market in the US. Certainly, we're at an all-time high in values. We're very close to all-time high in values. We're within 2% of the all-time high. Common sense for anything would say, we're at a risk for things to come down. And I certainly believe the overall chances of that happening is probably greater than the market significantly going up from here. I believe that there will be a slight market correction due to these factors. I believe that there will be a potential downfall in some of the values, but I don't believe it's going to go greater than 10%. Just because I don't believe inventory can be increased enough to cause values to keep on pushing down below that. And I don't believe that there'll be enough lessening in the buyer demand to cause where these won't happen. So I believe that as market values push down, I believe that buyers will scoop these up. I believe investors will scoop them up, and therefore keeping the market at a relatively even keel rate, even though it may go down to a certain degree in value. So the big question I get almost every day is, should I buy today or should I wait until the market drops in value? And the answer I give to them, it's all depends on your financial situation. So there is no one right answer for everybody or one wrong answer for everybody. So in this market, I tell my buyer clients that if you're looking to purchase a home, I always recommend in this market to put 10 to 20% down. That way, you'll have a decent equity position just in case the market does have a minor correction or has some kind of correction. You'll be able to get out of it. If you lose your job or if you need to sell, you should be able to get out of it and still have a positive cash flow on it. If you don't have that much money to put down, if it's less than 10%, and you feel like you do want to buy, you want to get your family in a home that's stable, and you feel like your income is stable, then as long as you have a little bit of financial resources to fall back on just in case the market does go down, just in case you need to sell, then you should be fine too. But the bottom line is we don't know what's going to happen. Again, for the past 2 or 3 years, people have been saying the market's going to crash, the market's going to crash. It hasn't happened yet. So we don't know, but it is always best to consider and be aware of the worst case scenario, to be aware of that, to have some kind of fallback plan in case that happens. I always suggest that to my clients, whether they're buying or selling. Just always expect that the worst could happen. Of course, we don't know. There's things out there in the world that could happen that we could never expect for. But having your own home, having your family in your own home is a peace of mind versus being out there and renting. So if you can get into a home, or if you need to get into a home, just get as much down as you can, get a little financial resource, a little bit in escrow, a little bit of in reserves there, just in case there's a rainy day that you need to fall back on. Then I think you'll be fine. I think you can ride out this market, and then we can be all talking about the next big rise in real estate values down the road. So again, in summary, I've tried to use opinions of others. I've tried to use stats. I try to use history to analyze this situation. I believe, again, that there's a strong consideration that we could see a market correction of 5 to 10%. Here in Florida, I don't believe we are going to see a crash just because there's potential positives of the future market outweigh what I think is the potential negatives. I don't believe that we're going to see a dumping of inventory, which is the only reason that we would see a market crash. But I do welcome your comments. I do welcome your opinions as to what you think is going to happen in the market here in Florida and in the US. And as always, thank you so much for watching, and we'll see you on the next video.